This doesn't look like 2008 yet, and that's exactly what makes it dangerous. So here's what people aren't really talking about: mortgage rates. Everyone says they've stabilized around 6 to 7%, but that's not really the full picture. Back in 2022, rates were around 3%. Today, according to Freddie Mac's primary mortgage market survey, 30-year fixed-rate mortgages have been averaging in the mid to high 6% range in recent months. That might not sound like a big deal, but it completely changes the math. Let me show you what I mean. A $400,000 home at 3%, you're paying about $1,300 a month. That same house today at 6.8%, over $2,100 a month. That's almost $800 more every single month. And that's the part most people underestimate, because prices didn't really drop enough to make up for that. According to the S&P CoreLogic Case-Shiller Home Price Index, home prices have continued to increase year over year, despite higher rates. So now you've got the worst combination: high prices and high rates, which means a lot of people are either locked out or stuck where they are. And that's what's quietly changing the entire housing market right now. But here's where things get weird. This isn't really a housing crash. It's more like a freeze. Inventory is actually dropping in a lot of markets right now, which doesn't make sense at first, because with prices this high and payments this expensive, you'd expect more people to be selling, right? But they're not, and here's why. A huge percentage of homeowners locked in mortgage rates under 4%. According to industry data, a significant majority of outstanding mortgages were originated when rates were below 4%. So if they sell, they're giving up a 3% loan just to buy another house at almost 7%. That's basically doubling their monthly payment. So most people aren't moving, they're staying put. And that's creating something really unusual. Demand is still there, but supply is shrinking. The National Association of Realtors has reported significant drops in existing home sales, while active listings remain below pre-pandemic levels. So now you've got fewer homes for sale, but the same number of people trying to buy, which is why prices aren't dropping the way you'd expect, even though affordability is getting worse. And that's what makes this market so confusing right now. And then there's the part nobody really talks about: who's actually buying these houses? Because it's not who you think. Right now, a huge chunk of homes are being bought in cash. No mortgage, no approval process, just straight offers. According to Redfin, cash purchases have increased significantly, representing roughly 30% of home purchases in recent quarters. And a lot of those buyers aren't even families. They're companies. Investment firms are buying billions of dollars worth of single-family homes. CoreLogic research shows investor purchases account for a significant portion of home sales, with institutional investors like Invitation Homes and American Homes for rent spending billions annually on single-family rental acquisitions, which means regular buyers are now competing against corporations with cash that can close in days. So if you're trying to get approved for a loan and they're writing a check, you already know who wins. And here's the bigger problem. They're not buying to flip, they're buying to hold, to rent, which means those homes aren't coming back on the market. They're gone. So now you've got two things happening at the same time: fewer homes to buy and more people being pushed into renting. But even that's getting expensive, because when large companies own more homes, they have more control over rent prices. According to Apartment List's rent report, median rent increased 3.2% year over year as of December 2023, while single-family rental rates rose 4.8%. So now people are stuck. They can't afford to buy, and they can't afford to rent either. And that's where this starts to become a much bigger problem. And here's the part that actually matters. This doesn't look like 2008, but there are still some similarities under the surface. Back then, the problem was bad loans. Today, it's something different. People are technically qualifying for these mortgages, but they're stretching to afford them. According to the National Association of Home Builders, housing affordability hit its lowest level since 1985, with less than half of homes now affordable to the typical buyer. A large portion of buyers are already spending more than 30% of their income just on housing. the traditional affordability threshold, which leaves very little room for anything else, and that's where the risk comes in. Because these aren't adjustable rates that suddenly jump higher, these are fixed payments that people are already struggling to keep up with. So if anything goes wrong, job loss, unexpected bills, even just higher everyday expenses, there's no cushion. And we're already starting to see pressure build. Consumer debt levels reached record highs according to the New York Fed, with credit card delinquencies rising to their highest levels in over a decade. Savings are getting thinner. The personal savings rate dropped to 3.4% as of November 2023, compared to 13.1% during the pandemic, which means people are more fragile than they look on paper. And that's the key difference. In 2008, the system broke first. This time, it's the individual buyer. And if enough people start to feel that pressure at the same time, that's when things can start to unravel. And there's one more piece of this that almost nobody's paying attention to. Regional banks. While everyone focuses on the big lenders, smaller banks are dealing with a completely different problem. A lot of them loaded up on low-interest bonds when rates were near zero. At the time, that made sense. But now, rates are much higher, which means those older bonds are worth a lot less. According to the FDIC's quarterly banking profile, US banks had hundreds of billions in unrealized losses on securities holdings. So on paper, many of these banks are sitting on significant losses, not realized yet, but still there. We already saw what that can lead to with Silicon Valley Bank in March 2023, which collapsed after realizing $1.8 billion in losses from bond sales. And they weren't the only one. First Republic Bank and Signature Bank also failed within weeks, marking the second and third largest bank failures in US history. A large number of smaller banks are dealing with similar issues. The Federal Reserve's stress tests revealed that 23% of regional banks would face significant capital pressure under adverse scenarios. And these are the institutions that lend to everyday people, small businesses, local communities. So if the housing market weakens and more people start struggling with payments, these banks feel it first, which means they tighten lending, fewer loans get approved. Credit becomes harder to access, and that slows everything down even more, not just for individual buyers, but for entire local markets. And that's when housing problems stop being isolated and start spreading. So, is it actually worth buying a house right now? The answer is, it depends. If you're buying something you can comfortably afford and you're planning to stay long-term, it can still make sense. But if you're stretching your budget, hoping rates drop, or expecting prices to keep going up, that's where things get risky. Because this market isn't as stable as it looks. And the people who get hurt the most are usually the ones who thought everything would be fine. But there are strategies that can help you navigate this environment. The key is having a plan that doesn't depend on everything going perfectly. Because this market rewards patience and punishes people who stretch too far. So if you're thinking about buying, don't just ask, can I afford the payment? Ask, what happens if things don't go as planned? If you want more breakdowns like this, real numbers, no hype, subscribe and watch this next video, because it breaks down what's happening to your money right now. Because what's happening right now isn't just about housing.